Something feels off. Prices are rising, jobs are becoming uncertain, and behind the scenes, the world's most powerful economy is starting to shake. The United States, the engine of the global economy, has faced recessions before, but each time the consequences were deeper, wider, and more unpredictable. Now, economists are asking a chilling question. What happens if it happens again? A recession isn't just a financial term. It's a silent storm, one that starts quietly and then spreads everywhere. From Wall Street to small-town businesses, from billionaires to everyday workers, no one is completely safe. And this time, the world is more connected than ever. So, if the U.S. economy falls into another recession, who really pays the price? A recession isn't just bad times. It's when an economy slows down for months, sometimes years. Growth stops, spending drops, fear spreads. Technically, it's defined as 2 consecutive quarters of negative GDP growth. But numbers don't tell the full story, because behind those numbers are real people. People losing jobs, businesses shutting down, families struggling to survive. When companies stop making profits, they cut costs. And the fastest cost to cut? People. That's when layoffs begin. And once layoffs begin, the cycle gets worse. Less income, less spending, more business losses, more layoffs. It's a domino effect. And once it starts, it's incredibly hard to stop. The first thing people feel in a recession is fear, because jobs disappear fast. Companies that once seemed stable suddenly collapse under pressure. Big tech firms, retail giants, even banks, no one is untouchable. Thousands, sometimes millions, lose their income. And when people lose jobs, they don't just lose money. They lose security. They lose confidence. They lose their future plans. A father who planned to buy a home delays it. A student can't afford education anymore. A family cuts down on basic needs. And this isn't just happening in one city. It spreads across the entire country. Because when unemployment rises, the entire economy begins to suffocate. When consumers stop spending, businesses start bleeding. Small businesses are the first victims. Local shops, restaurants, startups. They don't have enough cash to survive long periods of low sales. And one by one, they shut down. Even large corporations feel the pressure. Profits shrink. Investors panic. Stocks fall. Companies respond by cutting costs aggressively, firing employees, closing branches, reducing production. This creates a dangerous loop. Less business activity, less hiring, less spending, even weaker economy. And slowly, what started as a slowdown turns into a full-scale economic contraction. Then comes the market reaction. The stock market doesn't wait. It reacts instantly. As soon as investors sense trouble, they start pulling money out. Stock prices drop, panic spreads. Billions, even trillions of dollars disappear in days. For the rich, it's a major loss, but for the middle class, it's devastating. Retirement funds shrink, savings lose value, financial security disappears overnight. And when people see their money vanishing, they stop spending even more, which pushes the economy deeper into recession. Here's where it gets bigger. The U.S. is not just any economy. It's the center of the global financial system. So when the U.S. slows down, the world feels it. Countries that export to the U.S. lose business. Global trade slows. Currencies become unstable. Even countries like Pakistan feel the impact. Exports decrease. Dollar fluctuations increase, inflation pressure rises. Investors across the world become cautious, money stops flowing, and suddenly, what started in America becomes a global crisis. Sometimes recessions come with falling prices, but sometimes something worse happens. Inflation stays high even during a slowdown. This is called stagflation, one of the most dangerous economic situations. Prices go up, but incomes go down. People can't afford basic things: food, fuel, rent. Everything becomes expensive, but there's less money to pay for it. Governments struggle to fix this because if they raise interest rates, economy slows more. If they lower rates, inflation rises more. It becomes a trap, and escaping that trap takes years. So what can governments do? They fight back. Central banks like the Federal Reserve try to stabilize the system. They may cut interest rates, print money, support banks, stimulate spending. Governments may also provide financial aid, unemployment benefits, and business support. But here's the truth. These solutions don't work instantly. Sometimes they take months, even years, and sometimes they create new problems in the future, like debt or even bigger inflation. In every recession, the pain is not equal. The wealthy may lose money, but they usually recover. The middle and lower classes, they suffer the most. They lose jobs, they lose savings, they struggle to survive daily life. Young people face fewer opportunities. Small business owners lose everything they built. And the worst part? Recovery takes time, years for some people, and some never fully recover. So, what happens if the U.S. economy enters another recession? It starts quietly, but it doesn't stay small. It spreads across industries, across countries, across lives. Jobs disappear, businesses collapse, markets fall, and the world slows down. But history teaches us something important. Recessions don't last forever. They end. And those who understand them, prepare for them, and adapt to them are the ones who come out stronger. Because in every crisis, there is also opportunity. The real question is, will you be ready when it happens?